Okay, good evening. This is Ralph Mendez, and we're going to work on chapter 21 tonight, flexible budgeting and variances. And it's a pretty difficult subject for many people. So let's try to do a couple of them, and then we'll show its application in the real world. So in this case, based on predicted production of 25,400 units, the company anticipates 280,000 of fixed costs and 304,800 of variable. So, but if it only produces 19, not the 25, what do you do with it? So down here first, you're going to put your variable costs. And then here on this line, we'll put our fixed costs. So let's do what we know right away. 280,000 of fixed costs, 280,000 of fixed costs, and it's 280,000 fixed cost and 280,000 fixed costs because they don't change. They don't vary with production. Now, if the variable costs are going to be 304,000, at what level of production? 25,400. So that means the variable cost per unit is 12 because you got to divide this by this. So now if your flexible budget at 25,400 is the 304,800. But what about if you only produce 19,200? So you have to multiply the 12 times the 19,200 is the 230,400. So there you go. The flexible budget is based on different levels of production. All right. So let's go on to the next one. All right, so here's another flexible budget. Rodnick Company expects to produce 29,000 for the year ending December 31st. A flexible budget of 20,000 reflects sales of 438 variable costs and fixed costs. So then it wants you to figure it out at 27.1 at a different level. So now we have sales, so that's going to be your first item. Sales minus what equals contribution margin? Sales minus what gives you contribution margin? Well, it's variable cost. The cost of a pizza minus what the pizza costs them. The cost of a truck minus what the truck costs them. The cost of a hamburger minus what the cost of the hamburger is to them. If you go to a bar, they sell the beer for $5 and they charge you, and what did it cost them? $2 or whatever. Y'all have got to get this concept down. Okay, so now let's see what we have here. What do they give us? A flexible budget, 20,000. So now the fixed costs are, the production reflects sales of 438. 438 at what unit? 438,900. That's our sales. So now I'm going to divide that. 438,900 divided by 20,900 means we're selling them for 21. Multiply that by 27.1 now, and this sales over here should be 569,100. So this is the sales for that many. So to find out the per sales unit, then I multiply that. What's the fixed cost? 142. All right, so now, so this variable amount per unit. So now they said variable cost of 62.7 divided by for 20,900. So my variable costs are 3. So my variable cost, 438,900 divided by 20,900 means my sales are $21. My variable cost is 3. So my contribution margin is 8. So here, so where are my fixed costs? All right, so 21 total fixed costs are 142. Is that what it wants there? Oh, this is 20. So my sales are 438,900 divided by 20,900. So my sales are 21. All right, so now here are my sales. So my variable costs are the 20,900 times 3 is the 62.7 And what are they though at 20,000? 3 times 27.1, they'd be 81. So sales minus various costs, there's my contribution margin, but I'm not sure where it wants me to put the fixed cost here. Fixed cost of 142. Oh, here's what I did wrong. Sorry. Need to scroll down. Need to scroll down. 142. I need my fixed cost here. 142. You know, sometimes I swear these things do not work. And what is this income? Income from operations. Does it let me put the 142? Income from operations. No. So where am I get to put the fixed costs? Total fixed cost, 142. Oh, there. So I had to put it there and it put it there. All right. Okay. Sales minus variable cost. So you have to multiply the sales times a different production level times the variable cost at a different production level. Number 3. Again, so I'm not going to do this one. Oh, well, maybe we should because it shows the variances. But anytime you see the word contribution margin, how do you arrive there? Something minus something. So what is it? The sales minus the variable expenses, right? So on your flexible budget, assume that actual sales, so it wants actual sales right here, and it wants the actual variable expenses, and then you have the fixed cost. The actual are 131, and then here's your net income from operation. Well, what are my budget? Well, let's go up here to the top. They expect to produce 20,900 units for the year. A flexible budget of 20,000 reflects sales of 438. So let's go see what that is. If 20,000 is going to produce sales of 438,900, so 438,900 divided by 20,900 means they're selling for $21 times the actual units sold down here times 27.1 means they should have sold for 569,100. So the sales should be 569. The actual results are 524,100. So it means it's a $45,000 less. So that's a very unfavorable variance, unfavorable. Now your variable expenses are supposed to have been 62,000 for 20,000, which is $3. So $3 times the actual units you sold times the 27.1. So it should have been for this up higher level now, 81,300. And the actual is 113,800. So it's 32,500. And again, that one's unfavorable. It's more than it should have been. Now your contribution margin is actually 487,800 and it's 410,300. So there again, it's 77,500 unfavorable. It's less than it should have been. Now your fixed expenses, 131, and what were they supposed to be? Oh, 142. Sorry, let me see if I can get back there. In 131 there are, so there you saved 11,000. So that one's favorable. And how about your income? That's unfavorable too. So 66,500, and I'd say it's unfavorable. And let's see our results up here, if we missed anything. Okay, very good. So here are your actual results in this column. And then, well, what are the costs supposed to be at not this level, not at the 20,900, but at this level? So what are the costs? So these are kind of like standard cost or budget costs, adjusted up for this real level, and then compare. Okay. Now, let me see if I can give you an example of this. So first off, flexible budget, a financial plan of estimated your cost, the, oh, well, not going to work, huh? For different levels of output. All right. So let's look at one I created here. Let's just say you sell large pizzas for $7 and small pizzas for $5. Okay. And the variable cost, these cost you $4.50 and these cost you $3.50. So now your actual results are you sold 200 large, 200 small that night, $1,500, $900 there, and these cost you $1,000, that cost you $700. Well, what should the budget have been? Your estimate is you're going to sell 100, but then you sell 200. They're at 7, so 200 times 7 is $1,400. And 200 times $5, the sales should have been 1,000. So now look what happens. 1,400, and you actually sold them for 1,500, so it's 100 favorable. But they're adjusted up. Your standard costs, prices, sales are adjusted up for the flexible budget and then compared to the actual results to see how you actually did. Here, your small pizzas, you should have sold them for 1,000. You sold them for 900 because of specials and everything. So there's 100 unfavorable. So so here 450 times 200 is 900. 1,000 the actual cost, so 100 unfavorable. And here 200 times 350 is 700. So there is no variance. So this is an example of a flexible budget. You adjust the numbers up to the actual results and then compare what the results are to what they should have been, or your budgeted numbers. All right, so let's go back and see if we can do one more. Standard cost. So let's look at the materials, labor, overhead, materials, labor, overhead. All right, so now Batco makes metal bats. The quantity is 1 kilogram of aluminum, 0.3 of direct labor. And if the overhead is per direct labor hour, well, that's going to be 0.3 as well. And what's the cost here? $20. And the labor is 18. And your overhead rate is 36. So now you're going to have to multiply that by there. It's $2 there. And 3, 4, 5, 40. And 0.3 times 36 is 9. Is that 1080? Okay. All right. So let's see if we got it right. All right. So what did I do here? 1 kilogram at $20. Oh, it's $20, huh? It should be $20. All right. So let's try that. Okay. So now, what amounts would appear on a standard cost? A standard cost. Now, do any of y'all have standards where you work? Oh, yeah, you do. Oh, yeah, you have standards where you work. If you're at Federal Express or UPS, you got to move so many packages per hour. You're at Amazon, you got to move so many packages. You got to have so much production. If you're at a restaurant, you have to put so many slices of tomato on that hamburger, so much lettuce, so many ounces of onions. So yes, there are standards everywhere. And that's how people make, for people to reach their goals. And it's also controlling the cost. Like the big difficulty controlling in restaurants is portion control. You're a big guy and you like to eat a lot. Well, you might be putting more in everybody's plate than somebody else, that doesn't eat a lot. Portion control is big, but standards of movement and things like that are very important. All right, so now let's try another one. Cost variance. Okay, no, that one's the same. That one's the same as the deal. All right, now I'd like you to, let's figure this out because this is asking you for the materials cost variance. So you have to compute the total direct material cost variance and classify as favorable and variable. So you got to figure out what it's supposed to have cost and then what you actually paid. So the materials are 5 pounds at $10 a pound, so $50. So if it's $50 and you make 80,000, how much should you have spent? 4 million. 80,000 times 50 is 4 million, and you actually spent 4,029,000. So the materials cost variance is 29,000. Now, is it a much more or less? So it's unfavorable. It's more than it was supposed to be. Okay. All right. So that's what variances are. Hey, what should we have spent? And let me tell you something. You should be thankful for your education, because a lot of managers, they don't know how to do these things, variances and flexible budgeting, because they didn't have a chance to go to school. So this will give you greater knowledge, competence to figure out, hey, where are we struggling? Did we use too much or we pay too much? All right. So now here's the one I was hoping we'd get to for sure. And then, so here, what you're doing is, look how this is set up. Please set it up this way in your brain. The standard is what it's supposed to cost you. So here, it's the standard quantity times the standard price you're supposed to pay. And over here, you put the actual quantity times the actual price you paid. All right. Now, so look what you get. Actual cost, actual quantity, standard cost, standard price. So let's see if we can put this together. So here, we're supposed to put 4 pounds, and we pay $2 a pound. So $2 over here, let's just check this. No, that's not what I want. So I need, but because I'm making 76,000 units. So 76,000 units times the 4. Let me just see here if I put 304 times the $2. I should have spent 608,000. Now, how did I get to 304? 4 pounds times 76,000 units. 4 times 76 means I should have used 304 times $2 is 608. Now let's go check what we actually paid and stuff. The actual direct materials used were 360,000. Well, they don't tell us the actual price. Let's see here if the actual cost is 648. So take 648, the actual what you paid, divided by the actual materials you used to get the actual price you paid was $1.80. Oh, so actual cost was 648, and then it did the math. So this divided by that gave me $1.80. Now, right away, you can see your actual costs were 648. You should have spent 608. You're over. You spent too much by 40,000. But the trouble is, you don't know whether you used too many pounds or you paid too much. But now let's look at it just intuitively. You're supposed to pay $2 and you paid $1.80. You actually save money there. And you were supposed to use 304,000 pounds and you used 360. So this one is unfavorable. You use too much and you save money on the price. So we've got to figure this out. All right. So look here though. This in the middle is the actual quantity times the standard price. The standard price is $2. And then the actual quantity is 360. So you should have spent 360,000 pounds, your actual quantity, times the standard price of 2. It should have cost you 720 and you spent 608. So look what you're comparing here though. Actual quantity to standard quantity. You're comparing the quantity if they use too much because the price is the same. The price is $2. So this constant is being held. The price is being held constant. So on this side, between this number and this number, what are you comparing? The quantity variance. This is the quantity variance. And over here, notice this. The quantity is being held constant. What we're comparing is the actual price to the standard price. So this between these two, 648 minuses, this is the price variance. This is the price variance. So that's how we're figuring this all. Now here we should be your total direct materials variance. And this is a positive. And so this one here is favorable. You spent less, but you used too much. So please subtract this. 72,000 favorable minus 112 is 40,000 unfavorable. Now, let's just see if this is true. You should have spent 648 and your standard should have been 608. You spent 40,000 too much. 40,000 too much, but you don't know where it came from. And that, I know this is a hard chapter, but look what this chapter just did for you. 40,000, hey, we spent 40,000 too much. You guys don't know what you're doing. Well, now you know somebody actually saved money on the price, but then you used too much. Now, this leads to a lot of questions. You used too much. So is it your crew working, or did your buyer of the materials buy lousy material and then you ended up, it's not as efficient? So it leads to a lot of things. So you might have even found a new contractor and saved money and your crew's new. So this leads you to this. Now let's go on here a minute ago. Let me tell you why budgeting is important. In a minute ago, in a different levels, a flexible budget. So let's show you what's happened. 60% of businesses surveyed were closed for some part due to the COVID, and these companies experienced a drop in revenue of 87% compared to the previous year. Meanwhile, companies that were not closed saw an average decline of only 13% of business. And think about all the movie theaters, the restaurants, hair salons, bars. There are so many businesses, retail, have been negatively affected by this. So let's go look at some actual results to share with you, because I'd really like you to understand. Here, this is Darden Restaurants. And because we don't want to see the annual, because we want to look at quarterly. So that is a 10Q, not the annual. And if some of you had me for accounting one, you know we looked at annual reports, but we're looking at quarter to see what the COVID did. So now I've clicked on that, and we're going to go to the statement of earnings. And look, these are 3 months. And look at this, from August 2019 to August 2020 for those 3 months. Look at what Darden Restaurants business went down from, we got to put things in millions. So this is 2 billion down to 1.5. So they went down about 600 million divided by 2133. That's a drop of 28%. So almost 30% drop. Now, who is Darden? Darden here are their brands: Olive Garden, Longhorn Steakhouse, Cheddar Scratch, Yard House, The Capitol Grill, Seasonal, Bahama Breeze, and Eddie V's. So can you imagine losing 30% of your business, right there? So look at their net earnings. It went from 170 million down to 36. And so 170 million down to 36. So they're blessed to even stay profitable. All right, so that's Darden Restaurants. Okay. Now let's look at one more, please. Starbucks. They still had drive-through, but they had to close front door. So again, I went to the quarterly reports instead of the annual, because I want y'all to be able to compare those results. So look right here for these 3 quarters, from June to the quarter ended June 30th, 2019. Oh, this is 3 quarters and this is 1 quarter. They dropped from 16 billion to 13, almost 14 billion. They dropped $2 billion in sales in 3 months. So drop of 2 billion divided by 16 billion, that's a drop of 12.5%. And this drop here is from 5.5 on this 1 quarter down to, let's see here, 3.4 to 5.5. That's about 2 billion divided by 5.5. That's 36% drop. So for the 3 quarters, though, but we're just looking at 1 quarter, from June of 19 to June of 20. In the quarter over the next year's quarter, it dropped 36%. So please, this is real world. I mean, this is real world, these things we're working on. All right, so now I hope you can finish the rest of them. Let me just check. So this is the way I like you to set them up. Here's going to be the same problem, actual pounds, materials cost. It's actually, we went over those 2. And the labor, again, you're going to set up standard hours. Remember, standard hours times the standard rate. Standard hours, standard rate. Over here, what do we put? Actual hours and what you actually paid the people, okay? So fill this in, and then you're going to have, and then, oh, in the middle, you're going to take the actual hours times the standard rate. So look what you're comparing. Actual hours is the same actual hours, so that's a constant. So you're comparing the rate on this side. So over here, this is the rate variance. But over here, actual hour, standard rate, standard rate. So over here on this side, we're comparing the hours that people worked, okay? All right, and then let's just make sure y'all can do the rest of them. Labor cost variance, so that same thing, same there. And they use the following information to get the standard cost. All right, so good luck to y'all, and I'll see y'all Monday, and we have a speaker. Thank you. Good luck.